Welcome to the Wealth Steading Podcast. This is episode 482. Today is July 22nd, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, as I record this, markets are kind of jittery. I'm going to briefly say something about the general market, but then I want to hone in on three specific stocks. And my intent here is not to specifically highlight those stocks, but to talk about the importance of strategic diversification in your overall portfolio. So stick around all the way to the end and see how this turns out. Now, as far as an overall market update, we are in the midst of the dog days of summer. If you'd have asked me a couple months ago, I'd have told you that I would have seen a 5% pullback by now. And that was mostly because second quarter earnings were being pre-announced at a fairly low single-digit amount, which isn't bad in and of itself. It's just that first quarter earnings were in excess of 13%. Yeah, they really blew the analysts out of the water. And so I was expecting a really negative tone from the media narrative to talk about how, corporate earnings were down by more than, 70% or some crazy number, when in fact they really were just going to come along where they had projected to be all along. In any case, that number for second quarter earnings kept getting lower and lower. And that's also because companies sandbag just ahead of earnings so that they can come out and say, hey, we magically beat expectations. That happens more than 70% of the time, so it's not a coincidence, right? Things are planned to turn out that way. But right now we are seeing, for the most part, better than expected earnings. As such, the S&P 500 is holding up, much better than I thought it would have a couple months ago. I still have a nice cash reserve that if we get a dip in the next, 6 to 8 weeks, hopefully I'll be able to be smart enough and time that right to get in and buy at least some of the dip, if there is one. If there isn't, there's plenty of things on my dance card that I want to reinvest in as well as take new positions in. But what I wanted to point out about the overall general market, with the S&P holding above 6,300, we're continuing to see a broadening out of better performing stocks, and this is something we hadn't seen over the two previous years. All you heard about since the recovery in 2023 was the Mag 7 this, the Mag 7 that. Well, overall, we're seeing much better performance in the other 493 stocks, as well as the smaller indices, the things like the mid caps and the small caps. And that's encouraging news about the overall state of the economy, and I think the state of the stock market as well. Although, as I've mentioned in previous episodes, I am a little bit worried about all that FOMO, fear of missing out, and the insane piling into old meme stocks. That worries me. That could indicate a market top. But at the same time, I am encouraged that things like the mid caps and the small caps and the other 497 are doing better. Now, those indices haven't gone on to make record new highs like the S&P 500 or the NASDAQ have, which again, in a way, is a good sign potentially to show that the market isn't necessarily overheated, at least not in those areas. But, things like the small caps, they've had a hard time really since about 2021, which is when they did last put in their record high. But specifically today, if you look at the performance of the S&P 500 as I record this, it's pretty much flat. It's maybe up a couple basis points here or there. But the Russell 2000 is up over 50 basis points, so 0.5% today. The Dow Jones Industrial Average is up 30 basis points. The mid-cap S&P 400 index is up an astounding over 1% today. The equal weight S&P 500, as opposed to the traditional market cap S&P 500, that market cap S&P 500, that's the one you always hear about. My concern with that over the past couple years is that it has been too dominated by those dozen or so stocks. That's great when that small cohort of leadership constantly goes up. But, in recent times, they haven't been going up as much. And again, with the S&P 500 basically flat today, the equal weight S&P 500, much like the mid-cap index, is up over 1%. That's some extreme outperformance in the broader part of the market. That's very encouraging, especially so much so that we're in the midst right now of tech companies either reporting or getting ready to report their earnings. And on a day like today, the NASDAQ is down over 3 basis points. Again, that broader equal weight S&P 500 up over 1%. Extreme outperformance, very good relative strength from the other 497 stocks. So, hey, that's encouraging. And that really leads me into my main point today, where I want to talk about 3 stocks, but I'm going to talk about these 3 stocks from the point of diversification. And not only diversification, but strategic diversification. Diversification in itself just means spreading out your bets. But if you don't have a well thought out and rational strategy, if you're just spreading things out, that doesn't necessarily mean that you're doing yourself any good. If you simply put half on black and half on white, you've still got all your eggs in 2 opposing baskets. When I strategically diversify, in my case, I like to use individual stocks. I particularly like to do that over the last 6 or 7 or more years because trading commissions, trading transaction fees have totally gone away at places, like Charles Schwab, the discount brokers. So in the old days, when you had to pay $5 or $10 or more to make a trade, I say old days, that's going back 5 or 6 years. When I started over 40 years ago, I was paying $55 just to trade 100 shares of stock. So for all the people that think that you can't win in the stock market anymore, or that it's rigged, or that it's all about high frequency trading or artificial intelligent algorithms, listen, there's never been a better time in the history of humanity to be investing in the stock market. But in terms of diversification, it's gotten so much easier because if you're not paying $5 or $10 or more to make a trade, then you can effectively create your own exchange-traded fund. That's what I try and do with the way I manage my money and my client money. And when it comes to owning individual stocks, I want to start out with the premise of looking at particular areas that I think are either going to preserve wealth, and then other areas that are specifically going to have above average growth, and that's where more risk comes in. And I just don't have one theme or one factor, and it changes from month to month or quarter to quarter or year to year. The market changes, and therefore I have to change with it. You don't get to invest in the market you want, you have to invest in the market you have. And so when I talk about diversification, I am focusing on certain areas, but I'm not putting all my eggs in one basket with everything in one theme or one style or one trend. So for example, sure, I want to own some growth stocks, some momentum stocks. I also want to own some value and dividend stocks. I want to look at some stocks that are breaking out and potentially going on to all new highs. I also want to go and maybe do some dogs of the Dow investing where I think some stocks have gotten so bad they're finally good. And then in all of that, I also want to look at specific trends within the economy. Now, if you've been listening to me, in the last year or more, and really going back to 2016 when I wrote the book about the robots are coming, I've been a big proponent for a shift in the overall global economy and one that's going to have a big impact on the U.S. economy, specifically the stock market. And that's what I've been calling in, recent months, industrial tech or industrial digitization. It's not only investing in those tech companies that have done so well over the last 20 or 30 years, but also investing in some of those laggard industries that are the real nuts and bolts of the economy. Everything from aerospace companies to energy companies, railroads, mining companies. I think those specific areas are going to do well, not only because they're the foundation of a U.S. manufacturing and supply chain that's finally, since a pandemic has hit rock bottom, and through industrial policy and other changes in the national security plans of the country, we're investing more heavily in our industrial base and our supply base. And then to run all this automation and large language models and data centers, you need a lot of energy to make that happen. That's energy not only in the form of energy itself, but you have to transmit it. So you need copper to move the electrons. You need fiber optic lines to move the lasers and the light carried data. You need big steel pipes to move the natural gas and the petroleum products. And at the same time, these industries that are growing because they have to support the overall advancements in technology, they're also adapting and using that technology to become more efficient, more productive, and from an investor perspective, more profitable. And if you want to see the results of that, you don't have to look any farther than the shale oil revolution, which is where, for a period of 35 or 40 years, the United States was declining in the production of fossil fuels year over year over year from the 1970s all the way up until the mid-2000s. And then technology came in the form of horizontal drilling, which is all about big data and robotics and automation and advanced telemetry and sensors, and you put all that together, and the U.S. petroleum and natural gas industries reversed a 35-year-old trend, and now the U.S. is among the largest producers in the world of natural gas and petroleum products. That's what I think you're going to see in other areas of old industrial-type companies that were thought to be dinosaurs. Now, I think through automation and robotics and all types of technology, we're going to see advancements in those supply chains and those manufacturing hubs right here in North America. Now, not everything's coming back. I'm not talking about that, but we're definitely seeing a large reversal, and I want to own those kind of companies. So while I consider myself to be broadly diversified, it does revolve around a common theme of this industrial tech. But I digress. Hey, 3 stocks that I purchased about 6 months ago. I purchased them on the same day, January 31st, 2025. One of those stocks is up nearly 50%. One of those stocks is down a little bit, pretty much flat. And another is down almost 18%. Now, each of these 3 stocks fit into that trend that I just talked about. I had the same level of conviction that all 3 would prosper. I bought equal amounts of all 3, and yet one's down almost 18%, one's pretty much flat, and the best of the bunch is up almost 50%. A little more than 48%, but close enough to 50%. I'm honing in here on diversification. I didn't put all my eggs in any one of those individual stocks because maybe I would have picked the one that's down 18%. So that's why I split it up among those 3. And again, I had pretty much equal conviction on all 3 of these stocks. Let me just quickly run through them. And in fact, some of these, obviously you have more or less conviction on one or the other. As it turns out in this case, one of the ones that I had the most reservations about is the one that ended up doing the best. Okay, so as far as the one that was mediocre, it's Cheniere Energy. Stock symbol LNG. As you can imagine, it's involved in liquefied natural gas. That was way high on my list. I'm a big believer in natural gas. I think it's going to bridge the gap over the next decades as we do transition to nuclear energy. The U.S. is a major exporter of natural gas, and we're going to export more. And the natural gas that we have here in the United States is among the least expensive in the world, and we're going to use that to grow and build our industrial base. So, yeah, natural gas, I'm about it 24/7. I have a high conviction that it's going to do well, both in the form of a commodity as well as the ancillary companies that are involved in the supply chain of natural gas. Cheniere Energy, being a leader in liquefied natural gas, no doubt in my mind it's going to do fantastic, and yet here we are 6 months after I bought it. It's down 70 basis points. It's effectively flat. It's effectively done nothing. Now, it probably pays a dividend. I don't even have that data in front of me. It's not important to me. I'm just talking about the movement in overall stock price. So here we go. One of the industries, one of the stocks that I had high conviction to do well isn't doing anything. At the same time, I had another company, Zebra Technology. They're very much involved in the automation of manufacturing facilities, and they do so from not necessarily the bleeding edge of technology. So to me, they're a good, solid bet for advancements in North American manufacturing facilities and check out the data. You may have seen recently that, there's less factories being built in the U.S. Yeah, that's less factories over the last 6 months or so. But we are like 3 or 4 times or maybe more the amount of construction money spent on building new facilities in the U.S. compared to where we were, in the long-term averages before the pandemic. That whole supply chain mentality has shifted, and I think companies like Zebra Technology are going to do extremely well in the future, as they have done in the past. And yet, despite my conviction on that particular stock, guess what? As I record this right now, over the last 6 months or since I bought it at the end of January, it's down 17.7%. Now, the one that did the best was actually one of the ones I probably had maybe not the most reservation on, but yeah, actually I probably did. Of all the ones I purchased that particular day, this was probably the one I had the most reservations on, which maybe means that it was the most risky, which then therefore would translate into perhaps why it has done the best. And that's Seagate Technology. Seagate, up as I record this, nearly 48% since I bought it over these last 6 months. It fits in the technology side of the equation, and specifically in their case, they make, memory storage devices. I thought that was an overlooked area. Everybody was focusing on large language models and data centers, and one of the areas I liked to look at where I thought would be a recovery area would be a company like Seagate, where, they're not real, quote, high-tech in what they do, but they do provide a very needed nuts and bolts area within the technology sector, which is providing storage. And obviously, we're going to need more storage, just like more of everything else, with artificial intelligence and large language models and robotics and automation and on and on and on. And that has played out. It's played out extremely better than I thought it ever would have. I guess my biggest reservation in investing in Seagate back then was that it, does operate in somewhat of a kind of a stale commodity area of the technology sector. And investing in Seagate's kind of like going back to the dot-com bubble era of, mediocre tech companies. But it's played out extremely well. And something else I want to point out is all 3 of these companies did horrible during the tariff tantrum back in April, but I didn't panic. I didn't worry about it. And they've snapped back, again, almost unbelievably. Looking at Seagate specifically, it had dropped down into the low 80s, maybe lower, during the tariff tantrum, and yet today it's trading at over $145 a share. My message in today's episode is focus on strategic diversification. Don't put all your eggs in one basket. Make sure you have logical reasons for why the things you're investing in are going to appreciate in the future, and don't just groupthink and go with the latest headline or what some supposed guru or thought leader on social media talks about. Do your research, look at different areas of the economy, not just one, and place multiple bets. Because I want to zoom out even more. That day, January 31st, 2025, I didn't just buy these 3 stocks. I bought 30 stocks that day. And you can go back to my blog post, everything's archived there. Look up that day, January 31st, 2025. You'll see a list of the 30 stocks I bought that day. And I just gave you the extremes. I gave you the worst performer, the best performer, and the middle one of those 30 stocks. And if you just take those 3 I talked about and you average their performance, if that's all you did, if you just bought those 3 stocks, you'd come out at about, as of today, like 7.5% growth rate, which, hey, over the last 6 months, given all the turbulence, all the uncertainty, all the hand-wringing, I'd say that's a pretty good rate of return. But zoom out farther. Go look at all those 30 stocks I bought. Look at how many of them performed much better than the average. And again, these are stocks that are focused on that industrial digitization, industrial tech. And there's big names in there like NVIDIA and Microsoft. But there's also companies you probably never heard of like Amphenol. And if you average all 30 of those out, they not only did the 7% performance like the 3 that I talked about, but in fact, pretty much twice that much. And this is over just a 6-month period. Now again, I can't predict the future. I don't know what's going to happen 6 months from now. If you had to look back 3 months from where we are today back in April, May, yeah, these stocks were all down. Some of them down 30, 40 or more percent. So you not only have to diversify, you have to have conviction and not worry about nonsense noise in the headlines. Invest in good, solid companies, invest in a lot of them, and then sit back and let them grow on their own. Because all the worrying, all the talking, all the jawboning people do, it doesn't make any difference. The market does what it wants to do. So hey, there's my thoughts. Let's see how second quarter profits roll out this summer and what impact that has on the stock market. And come on back, we'll talk about it. Until then, as always, this is John Pugliano wishing you the very best returns.